Hello friends, welcome to my YouTube channel at OneRajKamal. As you go through this video, please do subscribe to the channel and also press the bell icon so that you can get regular updates as new videos are posted here. The last week was an up one for the market for all the major indices. Overall, the Dow Jones Industrial Average was up 4.89%, S&P 500 was up 4.74%, and NASDAQ was up 5.22% as you can see on this chart. These are quite significant gains for a week. And this was despite no major economic data and also in spite of Treasuries soaring and probably, bounce of the new lows of the cycle, and also probably a bounce as the markets heaved a sigh of relief with almost near certainty that the November meeting of the Fed would see a hike of 75 basis points. As we have discussed in the past, markets bounce of removal of uncertainty. The relentless march of Treasuries continued last week, and as you can see on this chart, the 2-year is now at 4.48% after being nearly 4.6% earlier in the week. 10-year is at 4.21% after being above 4.25%, and very importantly, the 3-month is above 4% for the first time since the 2008 crisis. Now at 4.04%. This actually led to an inversion of the 10-year minus 3-month yield curve. And this has happened for the first time in this cycle. This inversion is on top of the inversion of the 10-year minus 2-year that has now been continuously inverted since July 5. Please do note that the 10-year minus 3-month has inverted just briefly for a bit on October 18th. So we'll see what that means in the long term. Treasuries are strong in foreign markets as well. As you can see here, the UK 5-year, 10-year and 30-year are all above 4%. And the 2-year is at 3.7%. The German bonds are also above 2.4%. German bonds being above 2.4% should not indicate to anyone that these are not strong. Look at on this chart, the German 10-year Bund yields, which have moved from a negative territory throughout the COVID years and thereafter, and being negative also at the start of this year, to now a strong 2.4%. That is a strong reversal. This actually raises the question that why is the strength of the US dollar so high when treasuries are strong in almost all geographies? See this chart where you can see that the dollar is at its highest level since the dot-com crisis. Some people are therefore of the opinion that the strength in the dollar may actually be under threat because treasuries are strong in other geographies as well, and therefore there is a demand for yield in other currencies also, and we could actually be set up for a pullback in the dollar that may be positive for commodities and precious metals. Overall, bad data continues to flow in. See on this chart that the existing home sales have now declined to levels seen either during the COVID times or just after the 2008 crisis. And the sharp decline is reminiscent of previous recessions as well. We know the cause of this dramatic decline in existing home sales and also new home sales, and that is the surging mortgage rates in the US. The 30-year mortgage rates are now near 7%. That is incredible. Also see on this chart, margin debt has been coming down. It's actually been coming down since the start of this year. And the sharp decline again mimics behavior seen in previous recessions. So again, another source of information that points towards tough economic conditions. Finally, I did want to share something that I saw this week on Advisors' Perspectives. They come out with very interesting data. And for all the Fed haters, there is a sobering chart of US historical inflation since the 1870s that I'm showing here. This chart actually shows measured data since 1913 and estimations by Warren and Pearson prior to that. While inflation has peaked to nearly 40-year highs, see on this chart, and it is important to note that during the period 1870 to 1940, there have been periods of very high volatility in inflation where high inflation was followed by disinflation. Imagine living in those times and managing your business or your household when you suddenly had very high inflation, which was nearly double digits, and was followed by years where there was actually deflation. And look at the picture post the Second World War, when the volatility of inflation has actually go up. The Fed actually came somewhere around the 1910s. Has been a contributor to the economic landscape only post that. And if you take out the period of the 1970s, when you could argue that the Fed made notorious mistakes during the Arthur Burns years, who got very badly influenced by Nixon, inflation volatility is actually really, really low. So maybe the Fed has actually been doing something positive for the society. Thank you.